Last week, something unusual happened on Wall Street. It wasn't a rate hike. It wasn't economic data. It was the release of an AI coding tool that triggered a broad sell-off across the entire software sector. In just 2 days, software stocks plunged, and hundreds of billions of dollars in market value were wiped out. The market suddenly realized something. AI may no longer be just a tool. It may be starting to do the work itself. When AI can write code, review contracts, and perform financial analysis, investors begin to ask, will companies still need as many software subscriptions? Will software companies' pricing power be weakened? Yet at the same time, some companies are actually seeing rising profit margins such as AppLovin. So is this decline a structural risk or simply a perception-driven panic? To understand this sell-off, one key shift matters. AI is moving from being a productivity-enhancing tool to becoming an independent executor of tasks. That change is forcing the market to reassess software business models. Who charges per seat? Who profits from process complexity? Who can truly integrate into the AI ecosystem? We will break this down in 4 steps. First, the real trigger behind the pullback. Second, which companies are seen as most at risk? Third, which are actually benefiting. Fourth, why APP stands in a unique position. The immediate trigger. The direct catalyst was Claude Cowork and its industry-specific plugins. Anthropic's Claude Cowork is no longer just a chatbot, it is an automation system deeply embedded into business workflows. It introduces parallel engineering, allowing AI to break down complex requirements while multiple sub-agents simultaneously write, test, and deploy code. Its legal plugin claims to automate contract review, NDA classification, and legal summarization. Following this, legal information giant Thomson Reuters fell about 16%. London Stock Exchange Group dropped 13%, and LegalZoom declined nearly 20% at one point. Its financial and analytics plugins can connect directly to enterprise ERP and finance systems to conduct audits and risk flagging. As a result, traditional SaaS companies such as Salesforce, ServiceNow, SAP, and Oracle also saw significant selling pressure. On February 5th, Anthropic launched Claude Opus 4.6, featuring a massive context window and multi-agent collaboration. The market interprets this as a step toward potentially replacing certain professional software workflows. Users can now feed entire code bases, years of audit data, or large volumes of documents into AI without the earlier context fatigue. Investors worry companies may no longer need expensive specialized software if Claude can handle large private datasets directly. Opus 4.6's agent, Team Mode, allows multiple AI agents to collaborate. One writes code, another reviews security, another produces documentation. Wall Street fears this autonomy could reduce demand for traditional IT outsourcing and entry-level white-collar roles. Indian IT giants like Infosys and TCS saw some of their biggest single-day drops in years. Why the reflexive sell-off? The core concern is erosion of pricing power. Software firms traditionally charged per seat. If AI tools reduce human labor needs, long-term seat-based subscription volumes could shrink a risk the market is beginning to price in. Anthropic previously only provided models. Now, by moving into application layer plugins such as legal and financial tools, the market sees potential overlap with vertical SaaS functions. Companies under pressure. Stocks facing significant selling pressure include Salesforce, Adobe, Oracle, Intuit, and Cloudflare. This does not mean their fundamentals have collapsed. It reflects a repricing of expectations regarding how AI may reshape business models. Many of these companies are actively integrating AI, and large software vendors themselves remain key customers and partners in the AI ecosystem. Their future performance will depend on how effectively they embed AI into their platforms. The survivors. Some firms are not only unaffected but showing margin expansion or strong growth. IBM has reported strong AI-driven software revenue. Palantir has delivered high revenue growth and strong margins. Synopsys benefits from AI chip design demand. Okta's identity solutions are critical for AI security. Paycom maintains solid profitability. UiPath is evolving RPA into AI agents, becoming execution infrastructure for AI outputs. AppLovin. AppLovin stock has been volatile and declined during the sell-off, but some investors see it as a beneficiary of AI at the advertising matching layer. Its AI-powered Axon 2 engine has driven platform revenue growth of 60–90% year-over-year, with adjusted EBITDA margins above 70%. AppLovin's business is fundamentally about matching, and AI enhances rather than replaces this function. Its valuation has corrected sharply, trading at lower multiples than some AI peers, though still above large platforms like Google and Meta. Whether the current valuation is attractive depends on sustaining 40% plus growth, with upcoming earnings being a key test. Conclusion: the software pullback is tied to AI disruption fears, largely expectation-driven rather than evidence of revenue collapse. Industry leaders argue the reaction may be excessive, as software remains foundational to AI. AI coding tools improve productivity but have not yet replaced core software functions. Over time, AI adoption may raise industry efficiency while accelerating structural change. Thank you for watching. This video is based on analysis generated with ChatGPT and Gemini. If you found the content valuable, please subscribe, like, and share. See you in the next episode.